This is the High Mount Research Market Insights video for May the 3rd. Good afternoon, everybody. Willie Delwich here. Glad you're tuning in. It's time for another one of our weekly Market Insights videos, and it's early in the month. So this week, we're going to talk about the weight of the evidence, what's changed, what hasn't. So let's get right into that and take a look and see where the scales are. Last month, recall, we took sentiment and took breadth and took financial liquidity all off of the various sides, moved them lower. So we did have breadth and sentiment on the opportunity side. We had financial liquidity on the risk side. Those are neutral now. But that leaves us then with 2 on the risk side, 1 on the opportunity side. The weight of the evidence tilted slightly towards risk. I guess the big takeaway from the weight of the evidence would be this. We've got a market that is trying to fight the Fed, looking for a pivot in terms of interest rates. They'll probably raise rates later today. We're recording this just ahead of the Fed meeting. They'll raise rates, but the market thinks they'll cut rates later this year. The Fed not so likely to do that. On the other side, too, the market is also fighting the tape. If you're looking higher at a time when you've got more stocks making new lows and new highs, you're fighting the tape. And so that's really, I think, the challenge for a bullish case in terms of the market right now is that you're fighting both the Fed and the tape. And historically, not good to do either. Definitely not good to do both of those. So let's take a look at what the various components are kind of suggesting a few key takeaways from each of those. So start with liquidity. This is a chart of money supply. You can see at the top, that's the level that almost always goes up. You can see that reflected in the bottom line. The 12-month change has never been negative before until what we're seeing right now at minus 4% growth on a year-over-year basis. So liquidity is evaporating in terms of money supply, but let's go back to that blue line on the top. The overall level, yeah, it's come down a little bit, but it's still about 30% higher than it was pre-pandemic. So some of the excess liquidity is coming off. It's hard to say that the overall liquidity environment is really that bad. It's not to say that it can't get worse or will get worse, but it's from a money supply perspective, lots of money supply out there, even though it's starting to shrink right now. Going over to the economy, we talk about the fundamentals of the economy being a challenge. We can see that in terms of real activity not really growing, even though nominal activity is expanding. I think the focus here is, and we ties into liquidity, is what are we seeing from an inflation perspective? What are we seeing from an employment perspective? How is that likely to impact what the Fed is going to have to do, what the economy is going to have to withstand? The top line here, this is the median PCE. So the central part of that inflation trend, still high, 5.8% over the past year, still growing at a 5.6% clip over the past 3 months. Encouraging news down at the bottom, that's job openings per unemployed worker. This is what the Fed is looking at in terms of restoring labor market imbalances. And their story is that as this surged, as we had all those job openings, that's what fueled the inflation, the rise in inflation we've seen post-pandemic. Couple caveats here. One, inflation was high prior to the pandemic. We also had some labor market imbalances prior to the pandemic. So this isn't a short time frame type problem that we're dealing with. It's been around for a while. Second caveat, labor imbalances starting to improve. We haven't really seen that yet in terms of the central tendency for inflation. Yes, it stopped rising, but it hasn't really turned lower at this point. That's what the Fed needs to see if they're going to be able to ultimately stop raising rates and then at some point start to become more accommodative. From a valuation perspective, green line on the top here, that's the earnings yield for the S&P 500 forward earnings. So that's the inverse of the PE ratio. Yellow line, orange line, whatever color you want to call it, that's 1 year T-note yield. And even though the earnings yield for the S&P 500 improved as we're coming off of those valuation extremes at the beginning of the bear market, on a relative basis, stocks are as expensive relative to bonds as they've been at any point in the past 2 decades. So not seeing valuation improvement relative to bonds, even as we've gone through this lengthy bear market. From a sentiment perspective, this is where it gets a little bit interesting, and we can start to move out of conversations about what's happening right now and think a little bit bigger picture from a secular perspective. So the blue line, blue columns here, that's ETF flows last year total. The orange columns, that's year-to-date ETF flows. And you can see international equity, fixed income, their relationship is about what it was last year, progressing at about a similar pace to what we saw last year. What's really changed is investor appetite for U.S. equity ETFs, from $278 billion of inflows, more than international equity and fixed income combined last year, to a paltry $7 billion so far this year. We're seeing a shift in investor appetite away from U.S. equities. If that persists, then we can start to think about secular shifts from a positioning perspective, which we have not seen yet. Despite all the pessimism of last year, investors remain overweight U.S. stocks, underweight fixed income, relatively underweight international equity as well. So if this shift in appetite we've seen so far this year persists, then I think we can start to come into some of the rebalancing of those longer term imbalances between stocks and bonds. And the takeaway there is a shift away from U.S. equities probably is a near-term headwind for U.S. stocks, kind of getting some traction and moving higher. From a trend perspective, long-term trends in the U.S., from the S&P 500 perspective, improving. The 200-day average is rising. From a global perspective, the ACWI is turned higher now for the first time in 60-some weeks. So it's not just relative improvement overseas relative to the U.S. We're actually seeing absolute strength start to emerge. Within the U.S., get away from the market cap weighted indexes. Look at the Value Line Geometric Index, for example, 65 times now that it's crossed through the 550 level since the beginning of 2018. That's a cross through that level about once a month, every month for the past 5+ years. There's not a lot of progress. The trend is not higher when we take away some of the market cap weighted indexes, or if we're looking just in the US. Global trends improving, US trends much sloppier, much messier. Just a reminder, sometimes stocks trend higher, sometimes stocks trend lower, sometimes they move sideways. This is that kind of environment. And then finally, from a breadth perspective, started off the year strong, but that strength has dissipated. A blue line here, that's a number of days with more new highs and new lows over the course of the year. You can see we started off much better than what we saw last year. Over the first month of the year, we had more days with new highs and new lows this year than we had all of last year, but that has dissipated. We've stopped seeing that strength over the past 40 days, so roughly 2 months. We've had one day with more new highs than new lows. Over time, the S&P 500 does not move higher if we don't see strength beneath the surface, especially in environments where we don't also see some evidence of fear. And the VIX is in the teens rather than close to 30, which is where we would need it to be to indicate fear. And so this lack of strength, lack of fear, suggests a challenging breadth environment in the U.S. Again, global trends improving, U.S. trends are a challenge. And so that's the weight of the evidence update, still tilted toward risk a little bit. -1 from a weight of the evidence perspective. This is not an environment from my perspective where we need to aggressively look for opportunity. This is more of an environment where we want to protect against some of the risks. It's reminded of an adage. I forget where I heard it, but something pilots say about rather being on the ground wishing you were in the air than in the air wishing you were on the ground. I think that's the environment that we're in right now. Let the trends play out, let the volatility play out, let the market come back to where the Fed thinks rates are going to go, and then we can reassess. And as opportunities emerge, we can re-engage with the market. But for now, this is a kind of move to the sidelines type environment. That's the Market Insights video, the weight of the evidence update. Thanks for tuning in. We'll do another one of these next week. Have a great week, everybody.